There's been a time in Australian financial history where interest rates have risen so fast and so hard. And the number one question I get from my clients is, well, where's it going to end? Will interest rates keep on going? And most importantly, how do I prepare for it? The quick answer is probably to discuss what has led us to this point. Too much liquidity given by government during the COVID crisis, the Reserve Bank dropping interest rates to historical lows to get people to spend, and then the failure of government to tie in the liquidity, running continual deficits, and also the Reserve Bank keeping interest rates down for too low, so for too long. So coupled together has meant there's been too much money in the system, plus the supply problems with everything from energy, fuel, food, and also employment has led to a coming together of a calamity of too much liquidity. Prices will rise, and the government's got to slow it down. Unfortunately, there's only one lever the Reserve Bank can use in these kind of crises, and that is interest rates. They make a decision on the first Tuesday every month. They use figures from the ABS, the Bureau of Statistics. They use unemployment figures. They take into account the CPI, the Consumer Price Index, which is how they judge inflation. And from that is the basket of goods. They go into the CPI, which includes grocery bills and groceries and fuel and other expenses. And in the last 9 months, they've come to a conclusion, or the 10 months, they've come to a conclusion that they have to keep on raising interest rates to slow down the economy to get people to stop spending. Unfortunately, only 1/3 of the Australian households have a mortgage. 1/3 has got no debt, and the other 1/3 pay rent. So that means that all the responsibility at the moment is falling on one demographic, and that is those families who are paying a mortgage, and that is usually a demographic between the ages of 25 and 55. It's usually the demographic that's got the least amount of options when it comes to the amount of expenses they can cut back on, and the least amount of options to increase their income. So what does this mean to the normal household who has got a mortgage? It means that you've got to listen. The Reserve Bank is out to punish you. They want you to stop spending. So you need to make some hard decisions, and you need to make them really yesterday so that tomorrow is not going to be as severe. Now, if you're late to the game and you haven't cut back, you need to cut back on a few areas. The number one area you should be looking at is your discretionary spending. Your eating out, your coffees, your Ubers, your luxury items like going to the movies. Start to cut back where you can. The next area you should be really considering is your bills, your utilities in terms of your electricity. See if you can get a better deal. Your telephone bills. See if you can get a better deal with your mobile phone plan. And then after that, the next stage would start to be looking at your insurances. See what insurances you do need, what you're overinsured for, and lastly, you would start to look at your groceries. And should you be shopping at Woolworths, or do you start shopping at Aldi? Do you start to go to the markets? It really depends, and everyone's circumstances is different based on their own economic or financial position. So this is general advice, but I think there's something in it for everyone, and you should really start to sit down and do your budget to find out how it's going to affect you. So where is interest rates going to go? The Reserve Bank governor has indicated that he doesn't know, which means that you need to start preparing for not the worst case scenario, but a bad case scenario. If interest rates keep on going, let's say they go again another 4 or 5 times up, and I'm not saying that it's going to, but you've got to start thinking it may, especially when those who are making decisions don't know whether it's going to end. You need to start to really sit down and start to circle in your budget, if you haven't done one already, what's important to you. What's your red line? And it could be your health insurance, it could be the private school fees, it could be your holiday account. But whatever it is, you need to understand where you need to cut back or where you need to allocate your spending to so that you don't get into strife and you can't make the mortgage repayment. If you're in difficulty, speak to your broker, speak to your accountant, speak to your financial planner, speak to your mum if she's good with finances, but speak to people who can actually give you a bit of advice on how and how you should go about starting to restrict or reallocate your income and expenses. Of course, look for a cheaper mortgage. That is given. This is where your mortgage broker can definitely assist you. All banks are raising rates at the moment, it appears. There's no one really out there not raising rates. So it's not a case of trying to find the lender who is not following the Reserve Bank, but it's really about trying to find the lender who is the most competitive for your particular circumstances. If you find that you are struggling and you're going to miss repayments, of course, speak to your bank. Let them know your plan. If you're going to be in difficulty, it is easier to try to negotiate when times aren't as bad as what they can be. So if you feel that you're going to miss a repayment, call your mortgage broker, speak to your accountant again, or give the bank a call to say that, hey, look, I'm going to be a little bit late this month, but I've got a plan. If you don't communicate, and that's when things can get pretty bad. So from here, I would say really listen to the Reserve Bank, listen to what they're saying in terms of restricting your spending. It doesn't mean that the world's going to end. It's just a recovery point from COVID, and you would think that it may go on for a little bit longer, but it's not going to be forever. But it is for the now, and you need to prepare for it.